It's not a good time to be a member of a monetary policy committee. Inflation is far exceeding forecasts, and the Bank of England has been forced into something of a U-turn, belatedly increasing interest rates, in a shock and awe tactic designed to regain credibility. Some critics argue that the recent interest rate rises are like using a sledgehammer to crack a nut, engineering a recession and causing widespread economic pain, which will primarily fall on the most economically vulnerable. But whilst it's always easy to criticise, is there any alternative? What should the Bank of England be doing, given the difficult choices facing them? The first failure of the Bank of England was to underestimate the return of inflation. In 2021, the bank continued with quantitative easing, even as global inflation started to rise. In 2020 to 21, the Bank of England implemented £400 billion of quantitative easing, which combined with expansionary fiscal policy was a large stimulus. During COVID, saving rates soared as many households saw a rise in disposable income. This contributed to a boom in house prices, and when the lockdown ended, GDP bounced back. The 2020 lockdown recession was kind of artificial. It was like a turning off a tap, but when you reopened the tap, the pent-up water surged back. On its own, the stimulus might have only caused limited inflation, but combined with all the COVID supply shocks, followed by rising oil and gas prices, inflation crept up. And unfortunately, there is no doubt that the Bank of England forecasts have persistently underestimated the scale and duration of high inflation. Not only that, but the UK inflation has been one of the highest in the developed world. Now, this is not necessarily the Bank of England's fault. Brexit supply shocks have contributed to UK food inflation, and the UK was particularly affected by rising gas prices. But by getting behind the curve, inflation has become more embedded than expected, leading to a rise in core inflation. Even at the start of the year, the forecast was for inflation to fall back quite quickly, but unfortunately this has proved not to be the case. There's a saying that economists often end up using past models for today's problems. And if we go back to the 2009 financial crisis, quantitative easing and ultra-low interest rates probably helped stave off a deeper recession. You can criticise quantitative easing for its side effects on asset prices, but without QE, unemployment would probably have been higher. And when we got some cost-push inflation in 2012, the bank correctly predicted it would be temporary and soon fall back. But the 2020 COVID recession was not a structural financial collapse, and the scale of quantitative easing was in hindsight perhaps overgenerous. When inflation rose in 2021, there was a hope it would be like 2012, temporary and short-lived, but this was not the case. Now, economic forecasting is a tricky business, especially in a period of global volatility. Getting forecasts wrong is part of the trade. The real question is, what do we do now that inflation is stuck at 8.7%, significantly above target? The Bank of England have decided they will go for this shock and awe approach, raising interest rates more than expected and hinting they could rise to 6%. The logic is that this will reduce inflationary expectations and make it easier to bring inflation down. The bank argue that if they don't act, nominal wage growth will continue to rise, and this is unacceptable because it will cause even more inflation and more pain in the future. And they argue that if we allow inflation to keep growing, it may require even higher interest rates in the future. However, there are a number of concerns with this approach. Firstly, the Bank of England's own stress tests suggested that interest rates of 6% would cause an economic crisis on par with the financial crisis of 2009, with a big fall in GDP and house prices. Now, this stress test looks outdated given that the Bank of England's model of the economy has been proved wrong with underestimating inflation. But it is still worrying that interest rates could rise to a level the bank used to think just last year would cause a real economic crisis. Secondly, interest rates have a really big time lag, up to 18 months. And this means that all the past 12-13 interest rates will not have their full effect on reducing inflation until 2024. This week, 2 members of the Bank of England voted to keep interest rates at 4.5%. Their reasoning was, firstly, energy price shocks continue to go into reverse. Next month, gas and electric prices will fall, very welcome for many householders. And this isn't just a fall in energy inflation rate, but negative inflation actually going down. And this will reduce goods price inflation, reduce food inflation, and with some time lag start to reduce wage growth. Secondly, they point to the time lags of past interest rate changes that are still to be felt in the economy. So at this point in the economic cycle, raising interest rates further risks an unnecessary recession and inflation even falling below target in the medium term. Also, due to very high house prices, interest rates have a much bigger impact on mortgage payments than in the past. With interest rates going up, mortgage owners are seeing around £2,500 a year extra mortgage payments. And it's said that an interest rate of 6% is equivalent to something like 13% in the past. The economist Richard Murphy argues that rapid increases in interest rates can also have their own inflationary effect. Firstly, it causes an increase in mortgage costs, which is measured by CPIH, and we can see the rate of owners occupying costs have increased since interest rates started to rise, though I should add CPI inflation excludes these housing costs. Secondly, he argues that higher interest rates will increase the cost of borrowing, which firms then may pass on to consumers in the form of higher prices, and this may be important in areas like car leasing, which is strongly related to interest rate costs. And thirdly, some claim that higher interest rates will lead to higher rents as landlords try to pass these higher interest rate costs onto their tenants, although it's not clear to the extent to which they can do that. So it's an interesting point that higher interest rates can have their own short-term inflationary pressures. It's definitely interesting, but I don't think it should be overstated. It's only one business cost out of many, and if we take, say, food inflation running at 18%, indirect interest rate costs are only a small factor. And also higher interest rates tend to cause an appreciation of the pound, which will reduce import prices and reduce inflation. But the real problem with increasing interest rates at the moment is that the UK economy is in a kind of stagflation, high inflation and low growth. The UK is barely avoiding recession even at the moment, with economic growth only 0.1% last quarter. So in this climate, to reduce inflation by slowing down spending and growth is like squeezing a dry sponge. You only get a few drops of water for the amount of pressure you apply. So to reduce inflation through the medium of higher interest rates requires a lot of pain, and it's a pain that is focused on a relatively small share of a population, e.g. people who took out large mortgages recently. And this is another problem of increasing interest rates. It affects a smaller share of a population than in the past, because more young people have not been able to buy because of the high house prices. So the broad effects of higher interest rates on reducing demand isn't the same as in the past. Monetary policy works best when it is in response to strong economic growth. For example, go back to 1998. The Bank of England increased interest rates to 8% in response to strong growth. This rise in interest rates kept inflation close to target, but it didn't cause a recession or high unemployment. Growth continued to be close to the long-run trend rate of 2.5%. You could say this was a golden period of central bank independence, the Goldilocks economy, low inflation, strong growth and falling unemployment. And it shows that higher interest rates don't have to cause economic misery, but can finally tune the economy. But the 2020s are a very different economic climate to the 1990s. In the present circumstance, interest rates become a blunter tool, and their ability to fine-tune the economy is lost. Well, is there any alternative? If I was on the MPC, I would have voted with the two dissenting members to keep interest rates at 4.5%. And I should add, that's not just because I have a tracker mortgage. With falling energy and food prices, inflation will come down in the next few months. Core inflation has risen to concerning levels, and it has exceeded expectations. But I'm not so concerned about a wage price spiral because workers have really quite weak bargaining power in the UK. Despite labour shortages and record vacancies, wages have fallen behind inflation. Their weak bargaining power is highlighted by this stagnation in real wages and fall in recent months. Now, an alternative to bringing down inflation, which I would prefer if I was running the economy, is to use fiscal policy. If there's a need to reduce demand in the economy, higher income tax is a much broader based and more effective for reducing spending. Also, the government could reduce VAT to directly reduce the price of goods. This would give a temporary fall in inflation, which in the current climate would help change expectations and reset inflation, and give the fall in inflation a real boost. So I don't envy the Bank of England's situation. They've got a difficult trade-off. But I am very concerned that the rise in interest rates is going to cause unnecessary economic hardship for relatively little gain. I think that the increase in interest rates won't alter inflation much in the short term. I think it will fall, but not because they increase interest rates this month, but because of past interest rate increases and also the fact that energy prices have really turned a corner. Now, having said all that, there's no guarantee that inflation will fall as we hope. I mean, I remember at the start of the year kind of looking at Bank of England inflation forecasts and thinking, great, inflation's going to fall this year. It's definitely been more stubborn than we would have liked. But I feel that raising interest rates is a mistake at the time. Hope you like this video, and this is another one on why we have a mortgage crisis in the first place. Cheers, bye.